Today's session will be a brief introduction on the Eibi Report and EverEdge, and then the majority of the second half will be a discussion on the findings and a discussion with the panel in terms of what does it mean for real world scenarios, and what does it mean, and what are the trends that we're seeing with businesses today. So as we kick off, I do want to thank Michael Dilworth, who's the managing partner of Dilworth IP, and John Wood, who is the director of Waldron Center for Entrepreneurship and Family Business, to join us and to get their professional perspectives as experts in their fields around how this research plays into their industries as leaders in their field. So. All right, so those who have not heard of EverEdge, or this may be the first introduction that you have with us or involvement with us, I'll give it just a brief introduction of EverEdge. And we put ourselves out in the market as intangible asset specialists. We've been around about 14 years, completed over 2,000 engagements, and we work from companies from startups, even just idea stage, all the way up to Fortune 500 companies. And we're located in the US, Singapore, Australia, and New Zealand. And when people ask me, what does it mean to be an intangible asset specialist? The simplest way that I respond to them to that question is simply walk them through how we help people through the journey of identifying intangible assets. And we help them through this 5-stage process. We help them to identify what actual intangible assets a company has, controls, or owns, okay? Secondly, you take the process to assess, well, are these assets strong, weak? Are they protected? Is there risks around them? Once you know what you have and the risks and strengths of it, you can start to put together a strategy. So we help them develop a strategy of how to best position those assets in their firm. And then once you know what you have and you've positioned it well, you can actually start to then do a valuation on those and put a price tag on it. And once you know what something's worth, it becomes much more important to then either protect it or manage it more strictly. And you can also do things with it, which is the final step, is monetize it. Once you know what you have, it's positioned well and ready to go, you can either license, sell, do joint ventures, you can maybe partner with other companies, knowing full well of what you are bringing to the table is valued and protected. So the reason we talk about intangible assets is because these assets are everywhere, and they're not just what most people think of as, in the realm of when you talk to somebody about intangible assets, a lot of times people think, oh, you must be talking about, intellectual property. If you talk to a patent attorney, for example, or if you ask an accountant, they might say, oh, you're talking about things like goodwill. And if you talk to a startup founder or an inventor, they say, well, that's probably our secret sauce or our competitive advantage. But really, these are the assets that end up driving performance for most companies today, and they are everywhere. Everything from your networks and relationships to your regulatory approvals. And I'll illustrate this with a simple example, okay? Intangible assets are in most companies today, and even a company as heavy laden with property, plant, and equipment, and you would think of as an industrial company as something like a steel mill. If you take a steel mill, for example, and you think, what does it take to produce steel safely? Well, very, very quickly, you can see that to produce steel safely, you need things like safety manuals, you need people, you need the processes, you need systems, you need controls, you need regulatory approvals, you need certifications, and the majority of those assets are all intangible. And when you start to put that together, you see that without those things like software to run a steel mill, or a bill of materials, or where to get raw materials, and very, very quickly, you see that you can't actually produce steel safely without all of these intangible assets. And so to somebody, if you were to sell the assets of a steel mill to somebody who doesn't have the wherewithal capability to run it, and you don't give them any of the intangible assets with it, you're actually providing a liability in most cases. Now, another good example that we use to show why intangible assets are so important in businesses today is case studies such as Instagram. If you look at Instagram, they were sold to Facebook for $1 billion. And at the time, they had very little revenue, almost no assets, and only 12 staff. And the company was just under 2 years old. You compare a company like Instagram that is almost 100% intangible asset based to a company like Mainfreight that also has the same valuation of $1 billion. And how is this possible when Mainfreight makes 1.8 billion in revenue every year, and they already have $1 billion in assets on their balance sheet, and they're 40 years old? So when you look at these two companies and you take about the assets actually that are used to build up these companies, one of the main pieces, the answer is very, very simple, but yet surprisingly profound in the reason why the value of Instagram is the same value of someone like Mainfreight, is that tangible assets cannot scale the same way that intangibles can. You take something like a truck for Mainfreight. If you want to grow your business, you need more trucks, you need more drivers, okay? Instagram, for them to be able to scale, they've created the platform. They need to be able to gain users, and then people end up joining from a network effect. And so intangible assets have this ability that they can, scale sometimes infinitely. And so what we're really dealing with here, it's not economics per se, but fundamental laws of the universe. Tangible physical objects can't scale beyond certain limits, whereas intangible assets don't have those same limits, and so they can scale exponentially. Now, to apply this to certain industries, such as agriculture, okay? If we look at data from 1970 to 2020, agriculture group as a sector has grown about 40%. If you want to grow in agriculture business, you want to grow plants or livestock, you need more farms, you need more land, you need more stock to be able to continue to grow those businesses. When you take something like semiconductors and compare that, comparatively, it's grown 5 billion%. And one of the attribution to this is Moore's law. Okay, back in the 60s, Gordon Moore came out with the prediction that transistors, the density of transistors would double every 2 years. Okay, and this Moore's law has proven fairly consistent since then. Some say that there's a dip now. There hasn't been the same growth over the past sort of 2 to 4 years, but the introduction of something like quantum computing may end up surpassing computing power altogether and having a significant jump. But you take that Moore's law, there's really no same application of that into agriculture. And so when you take the element of looking for companies that are trying to grow, okay, we know inherently that companies and investors want to put money into things that are going to grow, that are going to go faster and going to generate better returns. So intangible assets can be a proxy for scalability, and scalable business models that can outperform and can better articulate their value to investors most of the time are intangible asset based. And the United States companies have been generally net acquirers of companies compared to other market studies in a part of our research. And that's due to the greater availability and lower cost of capital that the US companies have access to. So if you've seen this before, this is a study that was done by Oshitomo, and this is kind of set a little bit of the baseline of this growth over the past 40 years of tangible assets in businesses to intangible. And this is just a snapshot of the S&P 500. And when 40 years ago, it was less than 20% of value was intangible assets. And as that has grown, we wanted to break this down a little bit further, and through the over 2,000 engagements that we've done, we know this to be a fact of business today. We know that there is value here, but we wanted to understand, what are the other elements and how else can we see that this is playing out in the indexes and different markets and different sectors. And so what we did is we created the EIBI, okay, the EverEdge Intangible Benchmark Index. And we started by using sort of the existing approach. And the existing approach have found that, market capitalization as a measurement, combines operating performance and financing choices as part of that, the attribution of value there. And because it's not very clear, someone can grow based on equity or debt through acquisitions. We wanted to say, well, what is actually making up most of that value of intangible assets in these businesses? So we wanted a more accurate representation of where the value sits across all the global indexes. So what we did is, to neutralize the effect of financing choices, we deliberately expressed intangible assets as a proportion of the company's enterprise value, as opposed to instead of market cap, okay? Because enterprise value provides a more accurate measure of the capital that's actually required for any business, because it actually includes the debt the company takes on, to finance its activities. And so really, it's just a more robust expression of the importance of intangible assets for company valuations. And by doing it this way, it actually neutralizes the effect of financing choices. So that's what we did. We actually took that and broke that down. We started with enterprise value instead of market cap, and then we subtracted off the net tangible assets through the process, and ended up with the implied intangible asset value of the business. Now, if we go back to the study done 40 years ago, and we actually focus in now on just the last 20 years, because we have better solid index results that we can use to get more granular, we break that down and we see that, again, same thing, but we actually see a bit of fluctuation. From the tech boom, in the early 2000s, we saw that intangible assets were actually higher. And then as that seemed to dip back from, down to 72%, we now see it up to 85% across the S&P 500. So we started with the S&P 500 as the initial benchmark, because it's effectively the poster child. But we benchmark the S&P 500 across the other markets, or the other indexes. We use the NZX All Share, the ASX 200, and the FTSE All Share, which is a reflection of Singapore market. So this analysis actually uses as well the global industry classification standards. So those GICS and individual, it's the MSCI global industry classification standards. And it breaks it down into, there are 11 sectors in general. And so the reason why that's important is because we actually wanted to see specifically which industries were pulling their weight, and what were lifting and or depressing the overall numbers as they went up and down. And in this process, one of the things that we did to neutralize the effect of size of companies, we also weighted the index. We re-weighted the size of companies in the indexes to negate the overwhelming power of a behemoth like Apple in the sector versus a newer entrant that was 1/100th of their size. So we did some reweighting to actually see what the effects would be, to get a broader overview of what's going on in each of these sectors. Okay, so let me just break that down. I won't get too detailed into these. You can read through the report, but hopefully it gives some sort of type of it gives a bit of an understanding of what are the takeouts in the report and the breakdown of each of the markets. So I'll start with the S&P 500. So look, there's no surprise. The S&P 500 has the highest proportion of intangible assets relative to enterprise value. And really, this reflects the willingness of capital in the US market to ascribe value to these assets. So it's been around longer. People are much more willing to invest in information technology, and they are kind of accustomed to see significantly large valuations compared for startup companies and companies that are growing, as opposed to other indexes. And I think the reason for that is because what we talked about earlier, but it really is it's that capital has been willing to invest at these higher valuation metrics. Now, for the S&P 500, it's important to note that of the 11 sectors that are in the U.S., 7 of them all had an excess of 90% intangible value, right? Now, that is actually kind of an outlier when you compare it to the other indexes globally. And the only real underperformers, not necessarily underperformer in terms of business, but underperforming in terms of reporting intangibles and the impact of intangibles, the 4 groups that was utilities, real estate, financials, and energy. Okay, but so the data actually supported what we would expect to see. The start off in 2000, 78% reported intangible. Again, dip.com, slow down, and then back up again through 2020. And so really what we've seen is, higher growth rates of intangible asset companies in that group, expectations of monopolies created by companies that are generating sort of network economic effects. So companies that are able to, Facebook is a good one, Instagram, again, companies that are able to generate sort of network economic effects and kind of create monopolies in their sectors, we're seeing significantly higher intangible asset importance. And then I think overall from a S&P 500, from a sector, the United States companies have generally been, like we talked about before, generally they've been acquiring companies. Okay, there's more access to bring in new technologies and new businesses, and really that just ends up putting fuel on the fire for the S&P 500, right? And so what it does is it ends up, it's kind of a self-fulfilling prophecy, right? It helps to show that the strength of the U.S. market globally is the flywheel is spinning, right? And the more success you see, the more companies tend to go there to attract capital. And because there's capital, companies don't die out don't die out due to lack of access to important capital at critical times in their business. And so it continues to grow. And then you're seeing drawing in from the other indexes in the other countries. People want to come to the US for that very reason. You compare the S&P 500 to some other markets. I'm going to talk about Australia, New Zealand, and then Singapore briefly, because you see what happens when a sector can be significantly weighted in terms of one particular market. Now, the ASX is a good example of this, in that they actually perform quite well in information technology and healthcare. They had very, very high values of intangible assets, but over the past 20 years, we've seen it kind of just fluctuate sort of that 60% mark. And when you think about this, the reason is because Australia is heavily weighted into infrastructure companies, materials, mining, where they have resources. And that is not necessarily going to change. And what you do see is when you have high performing tech stocks, they've actually had a couple of good darling trials in healthcare and IT. But when you actually see the majority overall, a lot of them tend to end up dual listing and then moving over into the US over time as they grow and need access to larger capital bases. And that isn't all dissimilar to NZX, but New Zealand has done actually better in keeping companies in the New Zealand ecosphere. Now, and a good example of this is that the NZX shows, so since inception of the NZX All Share, they've tracked 116 companies, okay? And of those companies, they all still are there, right? And the intangible assets to, reporting intangible assets to enterprise value, it actually has risen over the 20 years and over the last decade significantly, because of a significant backing of a couple of primary companies. The companies like Fisher & Paykel Healthcare, and in the utility sector, we've actually seen quite a bit of growth. Things like Meridian Energy and Mercury New Zealand have really pushed that up. And those are companies that tend to stay. They're very New Zealand focused and based New Zealand. And so while, factors that affect other smaller markets, such as decisions to list either in other markets, New Zealand actually has performed quite well in maintaining and keeping those clients in their sphere. And the other factor is that investors in these markets, New Zealand investors, retail investors, actually have had less exposure and to be able to invest in the US. And it's sort of a less appetite to put your money, overseas. So that's mean that the large amount of capital that is available ends up going into the relatively few 116 companies that are listed there. And so they keep getting fed the capital that's in that small limited pool. Now, the last market I just want to call out is part of this index report is Singapore. And in Singapore, you might, if we look at this, you will look at the FTSE all share index. And so what this index is it takes a snapshot of 90% of all the companies that trade in Singapore, listed in Singapore, that meet a certain quality are part of this. And from 2008, when the index was actually constructed, you actually see a decline from 45% of intangible assets down to 28%. And it's interesting to note that over that period, the 265 listed companies that were there from the start, there are only 105 still listed. Okay, so you see a significant amount of movement of the companies that are on that exchange. And as well, when you drill down into what's left of those 105, 47 of them are actually property and developers, heavy asset rich companies like REITs and development and property developers. But really, just a last piece on this, the fall is really less a reflection on Singapore's business environment and more a reflection. I mean, the SGX and the index is not a reflection of the economy. All right, it's just a reflection of the appetite of the investors to invest in those types of stocks that are listed on those exchange. So, in a positive way for Singapore, they are seen as a very, very stable relative exchange for safe investments like property and financials. Banking is the other sector that's large there. And so it's just sort of that personality of that exchange. Now so what ultimately do we get of the takeaways of this? I'm going to summarize this up fairly quickly. But in short, we see that, confirmation that intangibles are the most valuable assets today. And more investment and more tracking needs to be done as we look at this as an overall asset class. And we're seeing it's confirmed that most companies that actually harness that element of the scalability of intangible assets tend to grow faster. A study that was done by McKinsey & Co. also showed that 2 out of 3 companies that invested in intangibles outperformed their peers. And so it's not just the people in this space that are doing research around this. It is becoming more mainstream and important. And what ultimately that tells us is that if we're talking about access to capital and looking at all these exchanges, really the capital and the capital pools are actually just chasing growth, okay? Which means that they're actually chasing intangible assets, but they may not have actually said that in those terms, okay? And so what we ultimately come to say is that companies that are in this cycle and want to grow and want to attract capital, there's more than one way to do this, and we've simplified it down to a very simplistic model, just for discussion. So companies that have an idea, technology, first they can start off by identifying what they have, and then they end up deploying that technology or service, and going out to market. And then that ends up seeing revenues and seeing growth, and then investors take notice. And so then they sit up and say, okay, well, hey, let's put our money behind that company. And so they have the ability to start to attract capital. Companies that can that can identify and articulate their intangible assets early on and show the ultimate scalability of those assets early on, don't have to go through that same process of proving the model and going out to show growth before they get on the radar, or even before they get to listings with SPACs these days, picking up companies that are still pre-revenue, but they want to get them in their groups for technology. We're seeing companies that are going directly from identifying the intangible assets that they have, going right to articulating their value, showing the overall value to the market through their messaging, through the narrative, through the comparisons, able to defend and back significantly higher valuations than their peers for various reasons. And then again, that allows them to attract capital. So you skip the steps, and the top road is a significantly longer process that can take years, whereas the bottom process can cut significant time off of that process. So look, hopefully that overall message is important if you're at the stage where you're either looking to raise capital, you're looking to track growth, or you're looking to invest, right? Intangible assets is another sector that we'd highly recommend. Go through the Eibi report, take a look at some of the other presentations and research that we're putting out there through EverEdge and the research that we're doing in the industry, because it's just becoming apparent that it's growing and growing by leaps and bounds every year. So look, thank you for listening to my pitch there and my spiel. Hopefully it wasn't too technical. And the purpose of today was to take some of this academic research and corporate research and actually show how it's actually working in businesses today. And so what we've done is we've actually invited a few panelists to join us today. So I want to go ahead and introduce you the panelists today, Michael and John. Go ahead and wave for the cameras. Thank you so much. All right, excellent. I'll go ahead and give I'll read the bios of these two, and then I'd love to hear their initial responses just to the report and the index, and the research that was published. So Michael Dilworth, again, managing partner of Dilworth IP. Look, the journey of innovation is an arduous one. At its heart, innovation is a story of hard work, courage, and determination in the face of challenges and obstacles, and all the interest of making the world a better place for humanity. As an intellectual property attorney, intangible asset advisor, and founder of Dilworth IP, Michael Dilworth speaks the language of innovation and the law, and he helps his clients protect their treasures with well-crafted IP strategy and with strategies to best leverage their most important assets, their intangible assets, so they can see to the marketplace. Michael, why don't you start, and then I'll give John's introduction, and then we'll give him a few minutes just to give his initial comments.
Thanks, Tyler, and great job on your presentation, and delighted to be here and joining John here for today's presentation. I'm speaking to you from New Haven, Connecticut, where I'm looking out the window and I'm seeing the first snowfall of the season coming down. So definitely winter has arrived in force here in Connecticut. What resonated with me in the findings? Well, really no major surprises, because I'm really familiar with EverEdge's work. Again, kudos to EverEdge and the work you've been doing all these years in bringing awareness to the value of intangible assets and managing those assets. So great job. But I continue to be astonished at the just really outsized proportion that intangible assets represent in the total value of most of today's business enterprises. You're looking at 90+% across the board, with some exceptions. And the way I like to think of it is there's a continuum. At one end of the continuum, there's like companies that have proprietary products and services. And at the other end of the continuum are companies that are selling pretty much commodities. And you see that reflected in the numbers, right? So you see very low percentage of EV for the gold standard of commodities, energy, right? Oil. It's the world's most, famous commodity. Low 20%. And at the high end, you've got IT, and you've got, computer science, telecommunications. And this completely jives with my experience as a 30+ year, veteran of the patent bar. Early days of my career, a lot of work, oil and gas. I did a good amount of work for Texaco, and that's completely changed. We've shifted up over to the proprietary end of the spectrum. Couple surprises in there. The fact that the gap is narrowing so in such an amazing way, in particular between industrial companies and high tech. I don't have the number right here in front of me, but industrial is definitely starting to get up there into the mid to high 80s. And I'm referring specifically to the S&P 500. I was a little surprised by real estate being as high as it is in the US, gained 30 percentage points over the last 20, 30 years. I'm not sure where that's coming from. I posit maybe it's the power of brands. And then materials. Again, that's my background's in chemistry. I do a lot of work in that industry. That's my space. Absolutely saw that increase by 23%, and that's reflected in our company's focus and execution on intangible assets and protecting those assets.
Yeah, excellent. Yeah, thanks, Michael. And I appreciate you being on the panel today. And your experience as in the IP field is what we wanted, in because it does help give a legal lens to some of this research. Now, also we have with us John Wood, who works for the Waldron Center for Entrepreneurship and Family Business. Look, John is the director of the center, and John is also is an IP attorney, IP business strategist, inventor, and consistently ranked the top 300 IP strategists in the world by IAM Magazine, as part of the IAM 300. He served as the executive director of innovation at Bridgestone, and he has extensive IP experience as the chief intellectual property counsel at Bridgestone Americas, and he's also the co-chairman of the board of National Inventors Hall of Fame, parent of Camp Invention, former president of Cleveland Intellectual Property Law Association, and is on the board of several other companies and associations. Great. I mean, John, thank you for joining us today. And since you have, a lot more of the sort of the exposure to some of these smaller businesses, the startups, and you understand the IP and protection angle, excellent, to have you here with us. So if you could sort of give us your initial sort of, takeaways from reading through the report before we jump into the panel questions.
Hey, thanks a lot, Tyler, and it's a delight to be on here. I'll agree with Michael. I appreciate you having me on here. I've followed EverEdge's work for a long time, and like Michael, I don't think I found a surprise to it. I like the way you're doing this with enterprise value, and I also I like the way you're looking at intangibles and managing intangibles holistically. So it's what I find interesting. I also found interesting the way that you compared different countries and the way that the value is recognized in different countries. Fortunately, in the last position I had at Bridgestone, I was able to work with a lot of startups and spend a lot of time in Silicon Valley. And I was in the mobility space and the changing ecosphere in mobility. And it was interesting to see the difference between the new companies and the valuation of the newer companies that are coming out, the Teslas of the world, or even the Ubers, the shared economy, they call it CASE, for connected, autonomous, shared, and electric. And so it was interesting to see the valuation of those, and you see the valuation of Tesla compared to the valuation of a Ford or GM, and the emphasis that the market is putting on these intangibles. I like the way that you look at all of the intangibles. You mentioned the network effect, which also these companies are getting a tremendous amount of data when they have this network effect. So when you have those two, you're actually building a barrier to entry for other companies to get into these spaces like Instagram and Facebook and even Uber and Lyft. So, and then that data allows them to continue to grow and add in value. So what I find though, a lot of times with startups, when they're quite early stage, and again, my last, I guess 7 or 8 years has been looking at startups, advising startups, sitting on boards of startups. I do still practice a little bit of intellectual property law, but it's mostly on the opinion or the strategy space. But it's interesting because it's not new. Like Michael said, that the value of these companies has been recognized, that the vast majority of the value has been in intangibles, but still we don't understand, well, even identify, then strategize, manage, and monetize all the steps that you've laid out. And what happens, and this is something that I give a lot of thought to these days, is that with the newer companies, like the Teslas of the world, you see they're getting a hit for their potential of their new intellectual property because they have something new and different. And I wonder if the old heritage companies, and I won't, let's say Continental, I won't use Bridgestone, but as a Continental, if they can have an intangible mindset and strategy as they grow, or whether their product-centric inertia of their mindset will keep them onto the side of the valuations that were on the lower valuations that you have. I did find it interesting that I want to pitch a quick question to you and Michael, is that I had a venture capitalist tell me one time, and venture capital in Silicon Valley is, as you know, is very active right now, and there's a lot of money being poured into Silicon Valley. And he said that, I can't control where the innovation is going to be initiated or come from or originate. But he said, we can control, basically, he said, I can't control the cats, but I can control the cat food, right? So everyone has to go through Silicon Valley for the money or come through these places because of the money, because that's the financial capital of the world for startups, which are mostly intangible in nature. I assume that's why the U.S. is getting that hit on the intangible value. But I noticed that I didn't see anything, I guess, in China, because you see some of these organizations like TikTok, or even some of the mobility companies, as not listing or being delisted from the markets in the United States. So it's sort of an interesting dynamic. The second thing is that I want to compliment you too for doing this in New Zealand, because I've seen other smaller countries like this that have really benefited from their understanding of intangibles. And you have intangibles, then you have the protectable portion of intangibles that Michael and I have worked with in our careers, which is the intellectual property is a subset of the intangibles that are legally protectable assets. But also you see that in Sweden and Japan have really done a good job in those areas. And I'm sure, I think that your work I know you're in the United States and you're working for EverEdge in the United States, but I think the work in New Zealand will pay off for these. So those are my initial thoughts. I have scribbled a lot of other things on here if you want to talk about them.
Yeah,
but,
well, look, I mean, John, let me actually address that one that you proposed, because I think it is important, and it kind of leads to an interesting takeaway from the report, in that you said, if you've got a VC that says, well, we can't control the cats, you can control the cat food. That is actually something that we've seen from Singapore, in that VCs and US investors have come in early stages, and they're buying up technology companies before they ever get to listing. Okay, so they're not getting the point where they're getting to list on the SGX and then they get bought or moved over. What we're seeing is that we have money that is coming from large pockets like, Silicon Valley, and they are actively looking. I worked with KKR Excel out of California to acquire an Australian technology company in real estate, okay? And the purpose of buying them at the time that they did was because they wanted to make sure that they could control that market, and they saw them as a leading player. So they never got to the point of saying, well, we are at the point where we need capital, let's maybe look at listing on the ASX. They got snapped up by a US VC before they had that opportunity. It also happened with a technology firm, robotics firm that I worked with in Singapore. And so you're absolutely right in that some of the impact of Singapore underperforming in that sector is due to the good technology is actually being acquired at an earlier stage. Yeah, and I think the other question, go ahead.
Let me ask you a question. So Tyler, is that these companies that are originating in places like Singapore and places where they may look undervalued are actually receiving appropriate intangible value because they're ending up in the United States where there's, is that correct?
Well, if they can articulate the value, I'll
right.
give you
I agree with
an
that
example.
completely.
Yeah.
I agree with your, and that's why I really like what you're doing. But this work of this value being here it's been out for the last 30 years, right? But still, there's a big need for companies like EverEdge, and I know that Michael does a lot of this. I'm spending a lot of my time in working with entrepreneurs and academia and that type of thing. But there's a huge need for what you do, especially for small and medium enterprises. So I just want to throw that out there. I'm sorry to interrupt. So
no, you are absolutely correct. Now, I'll actually use that as a case study to kind of articulate what we're talking about here. And in this case, well, I've already said the buyer, KKR Excel, but they went to acquire a software company out of Australia. And at the time, they went and their first initial offer was say, look, we're buying companies and we'll pay 3 times revenue for the company at this stage. They asked EverEdge, and I went to New Zealand, I sat down with the CEO and we said, okay, what are you worth and what are you worth to a big company like this? We did a valuation engagement, okay? We broke down all the intangible assets that the company had and broke them out and say, well, you've got brand, you've got software, you've got assembled workforce, you have data, you have regulatory approval to work in this space, you have a significant amount of intangible assets, and we broke them down in the report. When we stacked that all up together and said the value, I put the value on the company at 8 times revenue. And when we gave them our valuation report back to the VC firm, their response was, we can't work with you guys, you're unreasonable. And the CEO called me, he said, Tyler, you just blew up my deal. And I said, let's go through the report and let's ask them, we're flexible on price, but we'll just take out any of the intangible assets that they don't need or want. So we went through and did a page turn on the valuation report, and we went through it. The final selling price was 7.4 times revenue. Okay?
That's actually a brilliant negotiation strategy. So I commend you for that. That was great.
So no, I think that's really important process, because what we did is we identified the assets that the company had, gave them each a value, and then we're able to defend it through how it was being used in the business. So I think that's a critical piece, and I think helping to have that defendability in terms of whether something is just quoted on a forecast or whether it's actually defendable. We're seeing these in terms of rights, registrable rights and non-registrable rights, and how these are affecting things. Michael, this is probably your bread and butter. How are you seeing these types of registrable rights in the US, and how are these affecting drive company value?
A couple of things I've mentioned there. With registrable rights, what we're seeing is brand owners being extremely zealous and aggressive about enforcing their brands against infringers, to the point where we're defending our clients against what we consider to be pretty baseless kind of allegations, but our clients have to deal with it. But the flip side of that is that the other companies spent a whole lot of money building a really valuable brand, and they're going to do whatever it takes to protect that brand. So definitely seeing that. That's come up quite a bit in the last few years. Litigation funding is another huge driver of patent infringement litigation, particularly down in Texas. Basically, it's an industry that's been born out of patent aggregation. So basically, these are kind of legal entities that are created to own patents and then enforce those patents against alleged infringers, where the legal entities don't actually make anything. They don't sell anything. They don't make a product. All they do is own patents and enforce those patents against infringers. That has attracted investment capital to fund or finance that litigation activity. So we've definitely noticed that over the last few years. I think about 2/3, I might be wrong on this stat, but around 2/3 of patent infringement litigation in the US is being driven by these patent aggregators. So that's another big factor.
Yeah, so I think companies that can defend those intangibles by pointing back saying, well, we are legally registered, we've got this patent, we have this trademark, it is pushing value of brands up significantly. And a lot of investors are getting smarter. You know, as EverEdge, we do a lot of due diligence around, you know, what are the intangibles and the intellectual property that companies have, and it absolutely supports, you know, what you're seeing as well. And if that is increasing, but it's being moved into these aggregators, obviously there's value there because they're starting to go out and collect that, and it's starting to get collected into these, you know, behemoths that are going to control a lot of the intangibles or a lot of the intellectual property because they see it as a long-term asset. So,
you know, it's interesting that something that I wrote down that Michael reminded me of as he was saying that is during your talk, Tyler, which I also want to compliment you on it, like Michael did, because I enjoyed it. It was much nicer than me reading through it on my own. It's but is that I wrote down is not only the capital, not only is the capital here out of Silicon Valley or New York, but also you have the U.S. is still a huge market, right? So you still have a lot of so when people register their intellectual property or they file for or obtain legal rights, they typically do it in the larger markets so that they can defend it. And the third thing is that the legal environment, I guess, our U.S.'s mature, developed legal environment that has now started using at least legally protectable intangibles as financial instruments. And so it's like Michael said, is that you have litigation funding now, you have a secondary market, you have these other assets that are being recognized. So, you know, I was trying to figure out, and you helped me, Tyler, when you said that these U.S. venture capitalists or companies like Facebook, et cetera, are buying these people up in these smaller countries or different countries. That made sense to me. So I appreciate you saying that. But those are the three things that I wrote down regarding why that we see a lot of this in the United States.
And I think just to follow on to that, sort of the next, what is coming up in this industry? What do we expect to see? On terms of those, you know, using IP and intangibles as collateral against loans or financing is becoming more and more popular. You know, EverEdge was appointed to a approved valuer panel a few years ago as one of the first valuers to do what was called the IP financing scheme. And the purpose of it was to take patents, trademarks, copyright, and bundle it up so that smaller businesses, you know, could actually use that to get loans. And, you know, $50,000 loan or $100,000 loan or $150,000 loan for these small business to actually, because that's the sector of the market that's significantly underserved. You know, banks don't want to touch these small businesses, and VCs, it's not worth their time unless they're kind of at a size where it's you know, it costs them such amount of time to do their due diligence on a, you know, a 10-person firm as a 50,000 person firm. It takes about the same amount of time to do all the due diligence checks. So they go, well, let's go with the bigger money. So they don't spend the time they need to in that really, really bottom end town, bottom end size when it comes to companies. But early on, that's what we definitely, want to make sure that companies understand that those early stage times can be the most important. And having the identification of what your brand is, what your strategy is going to be, what it is expected to be worth in the future, and get it protected, right? Sometimes it means simply a trade secret strategy. And if it means patents and trademarks, then we pass them off to our IP attorney friends like Dilworth, right? I mean, it's, we see that early on. And so I think we can expect to see more of that in these markets in the future, of people being able to borrow and lend against that. So I just want to jump over. There is a couple of questions in the Q&A panel, and please, anyone else has joined, if you have questions, please join, or please put them into that Q&A piece. I'm just going to pull them up here. So there's 3 questions from Brian Kelly. Thank you, Brian, for adding some comments here. First question, the same intangible assets as we read in financial balance sheet statements. Good question. Intangible assets that are on a balance sheet are typically acquired from another firm, or they've been developed in-house, things like patents and trademarks. And typically what's reflected on a balance sheet, because of the financial reporting standards, IFRS and GAAP, that are used for most companies, they can only record an asset onto the balance sheet at what they acquired it for, at the cost, okay? Which means that the majority of assets today, things like a data set or things like a regulatory approval, most of the time end up getting expensed off through the creation or collection of that asset and never end up hitting the balance sheet. So the answer is no. Intangible assets are not the same as what is reported on a financial balance sheet statement. Equivocally, no. What are the main metrics tracked for faster growth in relation to intangible assets? That's an interesting one. Main metrics tracked, there are not a lot of sort of KPIs out there in terms of reporting intangible assets, which is one of the reasons why the EIBI was started. And the reason that EverEdge has started to embark on this research, to get a much more granular view of how companies are performing in terms of their peers inside their same sector, right? And once we create this as a benchmark, then we can see how they're actually performing versus their peers. So the main metrics that are looked at, we actually break down into those asset classes. Things like patents, trademarks, copyright, software, information, networks and associations are the kind of the core buckets that we would look at to initially look for metrics of how they've moved up and down. So. And last one from Brian, as an investor or business owner, are there bad intangible assets to be wary of or avoid? Well, actually, Michael, from a standpoint of an IP attorney, are there bad intangible assets or bad intellectual property that you can end up holding?
No, they're assets. I mean, they have some intrinsic value. It's definitely going to vary depending on the situation and circumstance, but if you own it, it's probably worth something.
Yeah, it's not necessarily the asset itself isn't bad, but what you can do with it can be bad, right? I mean, you might obtain a database. Owning the database is not bad, but if you leak that database or don't properly protect that, then you end up with significant problems. And so there are definite risks associated with the intangible assets that a company owns. So
sure.
Last question that's from Matthew Hagan. Have you seen any innovation in any other types of credit IP finance on informal IP? The source of intangible value go far beyond formal IP, but IP finance appears to be solely focused on formal IP, right? Well, I mean, Michael, John, have you seen with your dealings? I've got a few that I've seen that I've worked with. But from an other industry view, do you see other intangible asset types of finance or credit in terms of products that you guys help companies to obtain?
I can envision it being something like data would be, I think you could certainly be protected by trade secrets. So I could certainly see that. I've not done any financing in that area, but it's done all the time when you transfer businesses. The network effect would probably be just a business asset. And so I could see you making the argument to try to get financing from those. So a lot of these intangibles, I think you could make the argument like you did in your negotiations, Tyler, that you could get financing from these. Michael, what do you think about that?
I mean, what comes to mind is the example of the pharmaceutical industry. And I'm not sure if like regulatory approval fits neatly under the rubric of formal IP, but certainly we've seen it in the real world where, you get a pharmaceutical company and they can get tons of patents all day long on their pharmaceuticals, but it's not until the government gives them the permission to sell their product that, the stock, goes exponential. So that example comes to mind here, and I'm not so sure that that I've seen formal valuations being put on those kinds of licenses and permits from governments.
But there's streams of income that you would have financing on through contracts, though. So I mean, I think that Tyler mentioned is that one intangible asset is your relationships with other companies or your partnerships that you may have contractual relationships with. So there's a question in the chat, Tyler. I don't know if you see it, from Peter Cross.
Let me pull it up. Okay, if the asset is not allowing or protecting revenues, current or future, and it has a cost of carry, then it is a liability, no longer an asset. Absolutely true. Absolutely true. And a lot of times the assets that companies hold, if they're not properly rationalizing their patent portfolios, I mean, the metrics are crazy. It's some 98% or something of patents never end up generating any revenue or generating any royalties off of them, which means that most patents are strategic tools, okay? They can be used to help protect your business plans. And a lot of times it's only for a short amount of time, okay? And it may even be for defensive reasons. So you may just need to own the patent so that somebody else doesn't come in and publish something as new and inventive as their own. You can say, hey, actually, I'm sorry, but we have this. So interestingly, one of the patent methods that was introduced years ago was actually defensive publishing. And instead of patenting something that you don't plan to use, you just publish it in trade journals or somewhere that is unlikely to be maybe front page press, but it also protects your own position in that same market. Maybe not to the fullest extent, but in some ways it allows you to keep participating in that business without being kicked out by somebody who then later goes and files a patent over that technology or that product or service. So
I would throw in a pitch for you, Tyler, is that I think that you have to know what you own and why you own it. And so it needs to be strategically measured. In fact, you could probably, if you were to look at patent portfolio or any intangible portfolio, all of the intangible portfolios, you could probably save a company money.
Absolutely. Absolutely. And that's always a good process. Any good, IP manager, within a firm will continually look at, how to make sure that their costs are managed, because patents filing costs go up every year for the reason that it's set up in a way that they want people to share information. They don't want things to be, secretive forever. And so it gets more expensive for the owner for that very purpose. And it helps, industries and the overall, scientific community to actually get information out into the hands of people that will end up using it. So
I just want to add on one thing that you said earlier, is that when you're in startups, and one thing that I've seen in startups, and I'm sure Michael has seen this in his due diligence of companies also, is that it's important that you start off correctly because what you see is that you see that if you don't build a good foundation, you don't have the rights that you think you have. And then when you go to exit, whatever your exit is, if you're going for a sale, it can cause a lot of issues with that. From viewing things from a large company standpoint, I've seen that a lot of times where you can actually be devalued if you don't understand and know what you're doing when you're first starting.
Yeah.
If that makes sense.
Well, look, in terms of timing, thank you everybody for joining. We've got one question here. I'm going to wrap up with this last one and then final comments from Michael and John. The question is from Peter Cross. The scope of IP or intangibles that are being considered for transaction is stepping outside of traditional IP assets. Look, in terms of the discussion today, intellectual property and traditional IP assets are, historically looked at as sort of legal rights, patents, trademarks, copyright as one element. Yes. We are looking at intangible assets as a much broader asset class. And in terms of financing and traditional financing, there is coming on stream more opportunities. And we're seeing this across things like, music rights have always been there, but they're tending to be expanded out into other things, even trade secrets. I did an engagement with a company out of Canada where we actually licensed trade secrets of how to set up large commercial drawing technology. In addition, the things like data sets are becoming much more valuable. The bankruptcy of Caesar's Palace back in the 2000s, they ended up having the player data that had been collected for 17 years ended up getting sold multiple times. And the liquidators at the time had no idea how much value it was. It was later valued by Harvard Business Review at over $1 billion. And it was sold for almost nothing at the time. That's still in litigation today, years and years later, because the liquidators didn't identify the value of the player set of that database. And so many companies are maximizing this. Qantas Airlines was able to save their airline through revenues from their frequent flyer program. When they were losing significant amount of money flying people around the world, they made more money from their frequent flyer program and the associations they had and helping people get $2 off a Starbucks coffee than they were from getting people in seats to fly around the world. So we're seeing more uses of people taking intangible assets, quantifying them, and then finding ways to actually generate revenue streams off of that. Once you've got revenue streams, you can actually, that is then financeable. Banks will take that and they will lend against that. And so that's what we're seeing more about. So hopefully that answers that question, Peter. Thanks everybody for joining. Michael, John, any last comments for everyone joining?
Great job, Tyler. And, I guess with my final comment is, for the companies out there, you want to build a culture of IP awareness. And I think the report that EverEdge has put out here that goes a long way towards fostering that. So great job. Thank you. Thanks for having me on.
Thanks, Mike.
Yeah, I agree, Tyler. You did a great job. I greatly appreciate you allowing me to be on. It's a topic I love to talk about and I love to study and I'm passionate about. I put my email in the chat if anyone wants to contact me. We need to do a better job of IP education in the United States. So I appreciate what you're doing and value what you're doing, Tyler. So
thank you. Well, I appreciate your panelists today. Having industry experts like yourselves really just sort of pushes forward our work and what we're doing and try and get the message across. Thank you everybody for joining the session. There will be a recording that will be posted to everyone who's registered. You can get access to the report itself and contact details for any of the panelists. They'll be emailed out and available to you. So thank you so much for joining today, and everybody have a great rest of your week. Until the next report.
Thanks, Tyler.
We'll talk again soon.
To see you,
Thanks,
Michael.
everybody.
Stay warm over there. See you, Tyler. Thank you very much.
Thanks,
I enjoyed
guys.
it a lot.
Have a great day.